Our next speaker is Dr. Ira Silver, who has been NAAA's economist for the past 8 years. He conducts webinars, writes the NAAA Annual Review, and he's a regular speaker at conferences and communicates regularly with our members and partners through our publications, Facebook, and Twitter. Please welcome NAAA's economist, Dr. Ira Silver.
Thank you, Ellie. Okay, let me get started here. I'm going to start with a little story. An economist, a biologist, and an architect were arguing about what God's real profession was. And I'm going to refer to God as he, but it doesn't indicate anything, any knowledge of God's gender. So don't feel slighted if you're not a he. The biologist said God created men and women and all living things, so clearly he was a biologist. Wrong, said the architect. Before that, he created the heavens and the earth. Therefore, he was an architect. Before the heavens and the earth, there was only chaos and confusion. Well, the economist says you're both wrong. Who do you think created the chaos and confusion? I'm going to try not to create chaos and confusion today, although it does seem like there are economists in Europe, in China, and even the Federal Reserve that seem to be trying to create some chaos and confusion. So let me get started. This session is before lunch, and often people end up with some low blood sugar towards the end of the session, so they may doze off or not be concentrating as hard as normal. So what I'm going to do is I'm going to present the conclusions at the beginning. And just in case I get cut off, you will have at least seen the conclusions. Economic growth is going to continue, but it's at a lower level than in past recoveries and expansion. Looks like more like 2.5% than 3+%. Inflation is going to remain relatively low. It's very low, and it will remain low. And that's different from the past. It's rather surprising. Because inflation remains low, interest rates will remain low, but they will rise slowly. The Federal Reserve will, at some point in the next, say, 3 meetings, one of those meetings, they're going to raise interest rates, but not every meeting, certainly. Weak non-U.S. growth, for instance, in China and Europe, is going to slow U.S. growth, but that's going to dampen inflationary pressures in the United States. New auto sales will stay strong at least through 2016. I think 16 is going to be a peak for new auto sales, but they will not collapse precipitously after that. Auction volume growth will continue through at least 2016 at a reasonably high rate. And as you'll see, there are reasons to believe it'll be even further on than 2016. So let's get to this 3% problem, conundrum, as Alan Greenspan once said. We can't get to 3%. This is real GDP, percentage change in each year, with the red years being years in which there was red bars being years in which there was a recession. And as you can see, in past expansions and recoveries, we have lots of above 3% years. Even in the last expansion, was a fairly weak expansion, we have above 3% years. We have not gotten to 3% in this recovery after a fairly serious recession. So some of you may watch Orange is the New Black, which is a good show on Netflix. I do have Netflix stock. I just wanted to tell you that. So. And I'm asking, is 2.5 the new 3? So maybe 3% isn't the target. Maybe 2.5 is the new 3. So we maybe have to be willing to accept a slightly slower growth rate. If we look at this year, you can see there was a very weak first quarter. We've had a lot of weak first quarters in the last few years, and a big rebound. But even with the rebound, we're talking about a 2% average. So we're not getting to 3 with those 2 quarters. Now, a lot of you are probably thinking about the volatility in the stock markets. And I looked at the market about a half hour ago, and it was down a slight bit. The Dow was down about 20, but that doesn't mean anything. It could be up 300 now or down 300 now. Yes, there's a lot of volatility in the financial markets. Clearly, it's important to remember that what happens in the financial markets often has little relationship to what happens in the real markets. And I talk about real markets, I'm talking about people buying cars, I'm talking about people building houses, real things. I'm talking about people getting jobs, real things as opposed to stock prices or bond prices or interest rates. But that doesn't mean that you can forget about the financial markets, because the financial markets have the potential to reduce household wealth, and that affects confidence, both business and household confidence, and could lessen real economic growth. So it's something to be concerned with if it persists downward. The ups and downs are probably not going to change things too much. But if it's all downs, that could be a negative. So that brings us to the Federal Reserve. The Federal Reserve did not, the last meeting, they did not increase interest rates, and the market went down. I have a feeling if had they increased interest rates, the market would have gone down. But it's hard to predict what the market's going to do. But if you look at the real economy, the labor market is strong enough to justify higher than 0 interest rates. Remember, these interest rates at 0 were brought in when we had an unemployment rate of 10%. It's about 5% now. But despite the fact that we have a very strong labor market, we have things that are not so good in the economy and outside of the U.S. We have slow U.S. growth, which I showed you. We have a lot of foreign weakness, Europe, Japan, and China now. Low inflation all over the world, much lower than in the United States. Some countries have been almost close to deflation, which is declines in prices. Certainly Japan has had declines in prices. We have volatile financial markets, which are scary. So although interest rates in the United States are going to move up, they're going to move up slowly. So, we might not get to 2% until, the end of 2016 or into 2017. And what we end up with is going to be relatively low. So interest rates don't appear to be something to be too afraid of going forward, at least for a while. Now let's take a look at the labor market. I told you the labor market was strong. This is the month-to-month change in employment. This is that number that comes out, very important for financial markets. People watch it very, very closely. Probably the most important monthly number comes out usually the first Friday of the month. It's been running about 200,000. That line there is 200,000. And that's in an economy where the labor force is only increasing by 100,000 a month. And that's why we see the unemployment rate going down so much. These are good numbers. This growth here are good numbers. So it's a very strong labor market. If we look at the annual employment gain, last year had the biggest increase in jobs in the economy since 1999. And we're running almost, this is 3.12 million, we're running almost 3 million this year. We'll have to see, what the next few months bring. So that's very positive, given these giant declines in employment during the recession. So the economy, the labor market is strong. It's approaching full employment. This is the unemployment rate, which is measured over here on this other axis. And that's, like I said, it's down. The last month reading was 5.1%. A lot of people would say 5.1% is full employment. Full employment usually means anyone who wants a full-time job can get a full-time job. Now, there are other things going on if this was the only thing, and this really represented the overall employment picture, they probably would have raised interest rates. But there are other things going on in the labor market that the Federal Reserve is concerned with. All is not good in the labor market. This looks good, but there are pieces that are not good. Long-term unemployment, very high. After 6 years of expansion, we're still higher than it ever got during the worst of previous recessions. So still higher than previous recession peaks. So long-term unemployment's a problem. Labor force participation rate is a problem. People usually, when the economy is good, they come back into the labor market to get jobs because it's easy to get jobs. That hasn't happened. Also, part-time employment is a problem. Again, what we see is that the number of people working part-time this is what the Bureau of Labor Statistics labels it, for economic reasons, meaning they can't get a full-time job, but they want a full-time job, is, again, higher than at previous recession peaks. And this is after 6 years of expansion, so that's not good. So all is not good in the labor market. What about inflation? The Federal Reserve, I ask myself questions during these because I like questions. What about, which is a good question. The Federal Reserve targets both employment and inflation. And employment looks pretty good, although there are some slight problems in pieces of the labor market. They also target inflation, and they want a 2% rate of inflation. That target they are very far away from, and that's another reason that the Federal Reserve did not raise interest rates and is unlikely to raise interest rates very fast. Because everyone expects inflation to move up, but it's moved down for the last 4 or 5 years. And it's been below 2%. These are two ways to measure inflation. The blue line is everything, and the purple line is everything excluding food and energy, because food and energy go both up and down a lot. So they make the data difficult to understand. But both those lines are way below 2%, whichever line you look at. So the Federal Reserve is missing their target, and it's lower than their target. So in many ways, you could argue that they should, instead of easing, they should make monetary policy looser. So that's one of the reasons they're arguing about this and they're not willing to raise rates. So what that says is rates are not going to go up a lot very soon. So that's good for the easy credit. This is a measure that I use to look at the overall economy. It's the Industry for Supply Management indexes. And you have one for non-manufacturing, which is this orangey, browny orangey line. And you'll have one for manufacturing, which is the blue line. And what we're seeing a little bit of a mixed story. Manufacturing has slowed. It's not anywhere near recession areas, but it has slowed. That's a recession, but this is slowed. A lot of that is because of the strength of the dollar. Because we're the only major country in the world talking about raising interest rates. So the dollar has gotten very strong because everyone wants to buy U.S. securities, fixed income securities, bonds. And that drives the value of the dollar up. And that hurts our manufacturing exports. But non-manufacturing is up at its highest levels, at any time in the past. Now we go to what's very important for our industry, and that's new auto sales. New auto sales are the raw material of auction volume. I mean, your car is built and sold. At some point, some portion of the cars built and sold are going to come back into the auction, through the auction lanes. They're going to be part of the auction unit volume. So good auto sales will mean good auction volume. And as we can see, auto sales and housing starts, auto sales is in green, housing starts is in this orange line measured over there. So this is like 1.2 million. Auto sales are up at around 17 million, which is very high. Normally, housing and autos behave very similarly during an economic cycle. They move down sharply and they move up sharply. This economic cycle, because it was started by a housing problem, has been very different. Auto sales moved up sharply, doing great. They've been doing great. For a long time, housing starts hardly went anywhere, and they're still way below what you would expect given the demographics, the number of people forming households. They're picking up. So good housing market, a good auto market, a very good auto market, and improving housing market. Stock prices have come down a bit, but they're still very high compared to where they were during the recession. Home prices are coming up. So what's happened is that we've lost a little household wealth on the equity side, on the stock side, but we've gained it on the housing side. So this is good. Households still feel fairly wealthy, and house prices are usually more important for spending than stock prices. This is a very important thing. This is a measure of financial obligations, how much monthly payments people have. Credit cards, mortgage payments, auto loans, rent, anything that they have to pay on an ongoing basis, it's at a record low. So that means that people haven't been spending at a very high rate. That's one of the reasons that growth hasn't gotten to 3%. But if they decide to do it, they can, because they don't have a lot of pressure on themselves financially. We have two other areas that have lots of money. The banking system. This is this green line. This is what we call excess reserves. That's money that the banks have at the Federal Reserve, but they don't have to have it there. It's excess. They could take that money and loan it out to people if people wanted it, and they could get the rates they would like. And that's up at around $2.5 trillion. They must have been doing a little, taking it out, a little loaning out of funds. But that's a lot of money. The non-financial corporate sector has cash at around $2 trillion. $4.5 trillion, a lot of money. So this is money that can be spent on hiring, on investment, on buybacks. A lot of it has been spent, but it's still very high. And this is one graph that's a new graph. It's a graph that shows something called the yield curve. People have been, if you read the financial press or you listen to CNBC, people have been talking about recessions. And many people think that the stock market is an indicator of a future recession. When stocks go down in price, it means the market sees a recession. Now, one of the things that you look at to determine if a recession is coming is something called the yield curve, which is the difference between 10-year Treasury rate, the long-term Treasury rate, minus the 3-year month Treasury rate, 3-month Treasury rate. So the difference between long rates and short rates. And every recession was preceded by a period in which the yield curve went negative. I think this is quarterly data. It went negative for months over here, so we don't see it. So this is not a yield curve that would tend to indicate that the bond market, at least, expects a recession in the next 6 months or so. Okay, so my GDP growth forecast is 2.5% this year, and I still think we're going to get at least 3% year out of it, and 2016 is probably when. So I'm thinking 3 to 3.5 next year. Housing getting stronger and propelling this forward. Okay, now what about auto sales? Usually, the picture I have there usually is a much sexier car. I've had McLarens and Ferraris in there. But I was this is a Tesla Model S. I was very impressed with the ludicrous mode, which would allow this car to go from 0 to 60 in 2.8 seconds. I don't know how many people have ever been in a car that goes from 0 to 60 in 2.8 seconds, but must be quite an experience. Okay, but back to economics. Pent-up demand created during the recession. We still have some pent-up demand. We have a growing driving age population. We have continued easy, cheap credit. The Fed's not going to raise rates. We have the low household debt service burden, which I showed you. We have household wealth increasing as long as the stock market doesn't really crash. We have low gasoline prices, extraordinarily low gasoline prices, certainly helps the SUV market. We have housing coming back, very good for the pickup truck sales. And most importantly, and we haven't had this until the last 2 years, is a very improved labor market. People have jobs, they buy things, and one of the things they like to buy is very nice cars like that Tesla over there. So I am thinking, forecasting, that this year, and this is pretty much, it's going to be very close to this because the year is almost finished, is about 17 million units will be sold, which is what you see is that the gains in terms of percent are slowing, but we're at high numbers. I think next year will be the peak of this automobile cycle. Not that I think it's going to crash after that. 17.5 would be a record year. It would be higher than the previous record, which is, I think, goes in 2000 probably, yeah. So 17.5 million units. Now, if we look at auction volume, I like to look at auction volume in two pieces. It makes it easier to try to understand what's going on. I look at dealer consignment and commercial consignment. And as you can see, they sort of often are out of sync. Pink is commercial consignment, blue is dealer consignment. These are percentage changes. And what we've seen is during this period with very weak commercial consignment, the total was down. This is the total. It was declining. Anything below that is declining. In the last 2 years, we've seen both dealer consignment and commercial consignment move up. And that's why we've had 2 good years. This 2014 was the first year since 2008 that commercial consignment grew faster than dealer consignment. Now, I use this approach to come up with an idea of what's going to happen to auction volume going forward. So this is dealer consignment and light vehicle sales. Current dealer consignment is related to current vehicle sales. Because people buy a new car, they trade in a car, that trade in, some percentage of those trade-ins are going to go through the auction lanes. So this is a tight relationship. It's a good relationship on a percent change basis. So my forecast for this is supposed to be a little round. You probably can't see it. There is a little round shading over there. My forecast for new vehicle sales is those dotted lines, slowing growth, but still positive growth, which means dealer consignment is likely to have slowing growth, but still positive. The thing that's very critical is that there's a good relationship between current commercial consignment and past vehicle sales. Because when a new car goes into a lease or it goes into a fleet, rental fleet, it's going to come back to the market, and a lot of those cars are going to go through the auction lanes. Those off-lease and off-rental vehicles are going to come back and give us volume. I'm looking at this graph, which is about a 2.5-year lag between new sales and commercial consignment. But again, it's a good relationship. And the important thing about this, one of the hard things about forecasting is to forecast one thing based on something else. You've got to forecast to something else. So to forecast new car sales based on forecast dealer consignment based on new car sales. I have to forecast new car sales. But for commercial consignment, you don't have to forecast, because those cars, this is not a forecast. These cars have already been sold. They're out there. They're going to come back. I don't know if they'll come back in 2 years or 4 years or 3 years or 2, but they're going to come back. They're out there. They physically exist. And that means that we can be very confident that, assuming this relationship holds, which it has pretty much, that these commercial consignment numbers are going to continue strong into 2016 and probably for a number of years after that. It's baked in the pie. It's there, and it's going to happen. So my forecast for auction volume growth for this year is 7%, which would get us to 9.3 million units. And next year, it's 4%, which would get us to 9.7 million units. And a lot of that forecast is based on things that have already happened. So again, like I say, it's there, they're out there, they're going to come back. I guess then that's it. And I'd be happy to try to answer any questions you have. You're welcome. Thank you.